Mutual funds, index funds, or ETFs. I didn't know any of these investing terms or rules when in my late 20s I first arrived in the United States. It took me a while to understand these concepts, learning during both my education and work experience. Now I want to share what I have learned with you in a simple way to save you time and resources. I wish I had access to similar guidance when I began investing. It would have saved me a lot of trouble. Choosing between these types of funds can be daunting, especially for beginners. Although these terms are often used interchangeably, they have significant differences. So in this video I will explain each fund type and discuss the similarities and differences between mutual fund, index funds and ETFs in simple English, the only English I know. Additionally, I will provide examples of each fund and offer tips on how to select the best one for you. And if you stick till the end, I will reveal my most favorite investment options and why I prefer it. So let's dive in. Before we move on, if this is your first time on this channel, thank you for stopping by. If you are a returning subscriber, welcome back. I'm Ohan Kayakcan, also known as Ohan the Money Doctor. I'm a doctor of economics and a certified financial planner professional with over 2 decades of financial industry experience. This YouTube channel is about simplifying personal finance, saving, investing, building wealth, and self-development. The main thing these three funds, mutual funds, index funds and ETFs, have in common is that when you buy any of them, you are getting a mix of different investments all at once with a single transaction. To explain the important feature of having a mix of different investments, let's imagine a meal. While I'm not a nutritionist or dietitian by any means, I know that consuming a colorful variety of foods provides more nutrients to your body, making it healthier. Conversely, if you consume only carbs and sweets every single day, your body will lack the essential nutrients needed. This is similar to putting your money in mutual fund, index fund or ETFs, as these funds often provide diversification. If you put all your money in one type of company, you will face an unnecessary high risk of loss due to the lack of asset variety in your portfolio. As the saying goes, don't put all your eggs in a single basket. However, mutual funds, index funds and ETFs each work in different ways. They have different setups and they are managed and traded differently. Understanding these differences is crucial and we will go through them now. Let's start with mutual funds, which are perhaps the most well-known type of investment fund. Mutual funds started in Europe back in 18th century, but the first modern one was set up in the US in 1924, a century ago. Mutual funds let investors join their money together to spread out risk and have experts manage their investments. Most mutual funds are managed actively by professional fund managers who decide which mix of stocks, bonds, and at times other assets to include. When you buy into a mutual fund, you are getting a whole bunch of different investments all at once. Imagine if you had to buy each stock or bond in its own. That would be a big hassle. Since mutual funds have lots of different investments, such diversification helps lower the risk of your money. But just because mutual funds are easy to buy, they are diversified and managed by professionals, does not mean they are all great. Professional management, also known as active management, comes with a price. Usually high fees. These fees are anywhere from 1 to 2%, if not more, of the amount held in the account. These percentages are for annual fees. For example, if the fee is 1% on a $100,000 account, that's $1,000 in fees every year. You pay this fee no matter how well the fund does. It might seem like a small amount, but over time it can eat up a big chunk of your earnings. In some cases, more than 30% of your holdings over your lifetime. And to make things worse, most actively managed funds don't even beat the average returns of the stock market. About 80% of the time, they perform worse. Even the ones that do well often don't keep it up because fees eat up the gains. Now, let's talk about index funds. An index fund is a type of a mutual fund that aims to follow or copy the performance of a specific index. It's important to note that while all index funds are mutual funds, not all mutual funds are index funds. Unlike the regular mutual funds we discussed earlier in this video, index funds are managed passively. This means there is no manager actively choosing assets for the fund. That's why index funds have lower cost. They simply track an index, so there is no need to pay high fees for active management. The first index fund, called the Vanguard 500 Index Fund, was established in 1976 by John Bogle, who founded the Vanguard Group. This fund copies the S&P 500 index, one of the most well-known indexes in the world. It holds the same stocks as the S&P 500 at any given time. The companies in the S&P 500 change over time, and index funds that follow it change accordingly. Passive investment is the opposite of active investment. And as I mentioned earlier, fees for passively managed funds are much lower. For example, the Vanguard 500 index fund fee only 0.04%. That means for the same $100,000 investment, now the fee is only $40, not $1,000, like in the case of mutual fund with 1% fee. Most index fund names include the word index to differentiate them from other fund types. This helps to avoid confusion. VTSAX is one of the most popular index funds available. This is a Vanguard Total Stock Market Index Fund. Another is FZROX, the Fidelity Zero Total Market Index Fund, which by the way has 0% expense ratio. Now that we discussed mutual funds and index funds, let's explore the ETFs and see where they fall when you are making your choices about what type of fund to invest in. And if you stick till the end, I will reveal which fund type I prefer and why. So stay tuned for that. But first, if you like this video, give it a thumbs up and comment down below what question you have about investing, and I may answer it in one of my upcoming videos. The final type of investment fund we'll talk about in today's video is ETFs, or exchange traded funds. ETFs are like the younger siblings of mutual and index funds. They were first introduced in the early 1990s. ETFs are quite similar to index funds because they are also a mix of different securities, providing diversification at a low cost. But unlike index funds, which you can only buy when the stock market is closed, you can trade ETFs when the market is open, just like regular individual stocks. This flexibility gives you more control over your investments, but it can also tempt you to buy and sell ETFs frequently. However, I will suggest that you stay away from frequent trading unless you are a professional trader and you know what you are doing or getting in. Many ETFs, similar to index funds, track a market index, such as S&P 500. This means the investments in the ETF are the same as the companies in the S&P 500 index. So if you invest in S&P 500 ETF, you will own shares of those companies. ETFs often have low cost, also known as expense ratios. ETFs are also considered tax-efficient funds. Many brokerage firms now offer fractional shares of ETFs. Think of buying a slice of pizza instead of entire pie. Fractional ETF allows you to invest with as little as $1, making it accessible to more people. On the other hand, many index funds require minimum investment amounts, which can be thousands or in many cases couple of $1,000s. Some popular ETFs are VOO, the Vanguard S&P 500 ETF, and SPY, which is another S&P 500 ETF. As I promised, I will now share my preference between mutual fund, index fund and ETFs. I prefer index funds and ETFs over actively managed mutual funds. This is primarily because of the overall cost. Both index funds and ETFs are excellent choices for long-term investing. Between an ETF and index fund, my choice leans towards index funds. Here are two key reasons why. First, I value their automatic investing feature, which ETFs don't have. I prefer to make any transaction automatic if possible, not just in investments but also in finance in general. I arrange automatic transfers from my checking account to my investment account to regularly invest in index funds. Second, I choose index funds because the dividend reinvestment feature is simpler compared to ETFs. ETF dividend reinvestment often requires manual handling, while index funds offer automation, making it easier to save and invest without constant attention. However, it is worth noting again that ETFs are more tax efficient in comparison to index funds due to their low turnover. If you are investing in a taxable brokerage account, ETFs may offer slightly better tax efficiency compared to index funds. In summary, when choosing between mutual funds, index funds or ETFs, all boils down to their fees and diversification. With the right knowledge and information, anyone can become an investor and manage their portfolios effectively. By watching this video, whether you are already investing or considering starting, you are already ahead of many and making more progress. Thank you so much for checking out this video. If you enjoyed this video, give it a thumbs up, share it with your family and friends, and don't forget to subscribe to my channel. If you haven't downloaded my free guide to jumpstart your investing and building wealth, it is available completely free, and I will leave the link in the description below. See you in my next video.